Hi, welcome back to our Money Basics Chats with Alex.
Join me on my journey to financial freedom. Let's jump right in. Let's get started.
Yeah, let's get started.
Okay, today we're going to talk about stocks. Like in the last video, I know nothing, or very little, I should say. So I think maybe a good place to start is I will explain what I do know about stocks, and then you can tell me where I'm wrong or just elaborate more on it, and then we'll get the ball rolling.
Sounds good.
Okay, so stocks. I would define stocks as a company has a number of shares that people can buy, and their goal is to use the money from those purchases to enhance their company, grow it, and in doing so, along with other factors, the price of the stocks will go up or down, and people can make money from buying stocks by buying when they're less expensive and selling when they're more expensive.
That's ideal, yes.
Okay. So I guess, yeah, is there anything you would add to that?
That's a great summary. I guess I just want to draw a trajectory of how that happens.
Sure.
So yeah, first a company decides to go public,
Okay.
for obvious reasons, to raise money. And then what they do is they issue shares, and an investment banking firm will help them through that transaction.
Okay.
Now, what happens is they will sell those shares to institutional investors. That's something called primary market.
Okay.
Like that's where the first transaction happens. And when the retailers like us, when we buy, that's something called secondary market, which basically means once that the transaction is done in the primary market, there are certain shares that are available for trading.
Okay.
So those are the shares that we have access to through the brokerage.
Okay. So is a brokerage, are they considered an institutional investor, or are they just something separate?
So brokerage is basically an intermediary between buyers and sellers. They connect the buyers and the sellers.
So would they be kind of between the company and institutional investors, and then also between retail investors and institutional investors?
So that's an interesting question. Yeah, in every transaction, there's a brokerage that takes care of that transaction. Now, previously, decades ago, I don't know when even, but they used to do it literally like physically on paper, right? The brokerage, he'll get the order, he'll go and put it in. Right now, that's, with technological advances, that's not the case for a majority of part of it.
Okay.
Especially for the small trades, it happens all electronically.
Mm-hmm.
But the institution, like for example, Robinhood or Charles Schwab or Webull, they are brokerage, as an institution, and they have the technology that takes care of the transaction automatically. If I put, for example, let's say a market order, which means basically whatever price it is available at currently, that's what, at what price I want to buy it, and then it will automatically connect me to the closest the current market price that there is available, and make the transaction happen, which takes milliseconds.
Okay.
Right? And then if I put a limit order, for example, a limit meaning I'll put in an order that says I want the stock at X amount of dollars.
Okay.
Let's say if it's, for example, trading at 25, and I think it might go to 24 just because of the way the volatility is currently. I'll put in a limit order saying at 24, or I think that that's what the price I'm comfortable with, right? Or I think that that's what the value of the company is. I'll put that dollar amount and put that in order, and then what the computer would do is it will connect whoever sells it at that amount, it will connect us.
Okay.
So, you know, that's the current, and then the when they're bigger, yeah, there's more, you know, like physical human broker involved.
Okay.
Which, you know, like there are different cases, like, you know, brokers are still there physically. Some companies offer like help, like you can call up a broker and ask, you know, for advice on a certain company. But majority of the small transactions are still done, you know, through computers.
Okay. So what are some different, I guess, strategies or ways to buy stocks? And
Yeah,
sell them?
okay. So we have like, you know, institutions and retailers. So whatever, you know, I'll be talking about is specifically towards retail investors,
Okay.
although it applies to both. But for the sake of the video, I'll be mostly focusing about information for retail investors.
And retail investors are people like us, right?
Small investors, yeah. Retail investor, so there are different strategies, right? You could do day trading, which, you know, from the name you could guess that you trade within a day, or I think you could apply also to a couple of days too. Like, you know, if you buy today, sell tomorrow, to make a small gain. But the main strategy within the day trading is you trade on margin, which is basically the brokerage loans you a certain amount for the part of the transaction for you to carry it out, and then, you know, you make money on the difference of paying the interest on the loan and your gains. So even though it magnifies your gains, it also magnifies your losses. So if you're not careful about it, you know, you could lose to a point where it's lower than, you know, what you have. Because the way it works is that if you're, so say for simplicity, it's a 30% and 70, like you put in the 30%, 70%, you get a loan.
Okay.
Now, depending on the stock, that is different. Some stocks, for example, if they're risky, the brokerage might require a 50% from your end, and they would loan you 50%. So the way it works is you need to maintain that 30 and 70% balance at all times. If the stock goes down, you need to put in, you know, more money in order to maintain that 30% and 70%.
Okay.
Let's say, for example, you buy a stock for $10, right? And then the brokerage loans you the $7, and you put in the $3. So now when the stock price goes down to $9, that 70 and 30% now is disbalanced. So let's do a quick calculation. So if the stock price goes down to 9, that means that the brokerage percentage is way above the 70%.
More than 70,
Yeah. So you need
gotcha.
to balance it out and bring it back to that 70-30%. For a simple calculation, if it drops to $9, now you need to put in 70 cents for every share in order to bring it back to the balance. The way it works is like if you multiply 9 at 70%, it comes to 6.3, which means that the value of the loan has dropped to 6.3. You need to bring it back to 7.
Okay.
Because the initial loan was at $7.
Right.
So you need to like balance it at all times.
Okay. So do you have to balance? It doesn't matter the 30% that you put in. Does that matter in balancing out, or is it just the loan that you have to balance out?
So this is in your account.
The $3.
The $3 is in your account, and then the 7. So you're basically, the $3 is kind of like as a collateral,
Okay.
and the and whatever you borrow is, you know, you use them to buy securities, and then, you know, if they drop in value, like they'll bring this down to 6.3%. So you add the 70 cents to bring it to balance.
So basically, you only have an amount of shares that the 70% loan can buy.
Yeah,
Okay.
yeah. Because
Okay.
you need to keep cash as a collateral. The broker, in case of adverse actions on the stock, like if it goes down, the broker has every right to force sell them, and take the cash, including the collateral, if they need to like cover, the loan and
Okay.
everything.
Okay, so the collateral is that for any losses? Wait.
Right.
Okay.
Yeah, because it can go down, like it could go even lower than what you loaned initially.
Yeah.
And then you'll have to pay out of pocket to cover those losses.
Okay.
Yeah. So that's the risk of trading on margin. Like you
Okay.
could lose more than you have the money for. Like you can even lose less than the collateral. Although I think in those cases, like the broker wouldn't allow it. Like they'll force sell it to cover their position and cover, in order not to incur losses. It's just that in some cases there's just such a sharp decline that even the broker might not be able to sell it on time.
Okay.
But in time to cover everything. So it's high risk and it's heavily regulated. Like if you want to open, like not every brokerage account has margin, right off the bat when you open the account, you need to apply for a margin account, and there's usually a procedure, like they need to make sure you know what you're doing. So for you to have, open a margin account, you need to specifically state that, and you need to, go through the rules and acknowledge and everything. So yeah, that strategy is basically, your gains are magnified, but so are your losses. So it's a lot of risk. I personally don't prefer it. I haven't used margin. I don't just feel safe, when I do that. I don't want to lose the money I don't have. So yeah, and you can make gains on small movements in the stock price. I've done it once. I've done day trading once. I haven't used margin, but I did day trading. And the way I would go about it is when I buy something, I specifically did penny stocks because I could buy thousands of shares on that. And then if it goes, say, 20 cents, which is a realistic movement expectation, not necessarily you can be sure that it's going to go 20 cents over your price that you bought it at, but it could be doable in some cases. And then you basically make on one, like if you buy 1,000 shares with a 20 cents movement, you make $200. It was fun, not gonna lie, but it's pretty volatile and you have to feel comfortable. I personally had my fun, and it kind of got too much to handle, because it could be a lot of volatility, a lot of stress involved around it, which I thought, it's not that, there's so many better ways to invest in the market. So I decided to take a different approach, which I'm working towards now.
What is that?
It's the it's kind of value investing, but let me clarify what value investing is. It's basically you go through the company, you research the company, you research the 10K, which are the financial filings and other materials that come with the company filings. They file it every quarter and then once a year, a more comprehensive one. And there you can get all the information about the company, the risks that management sees, and the outlooks of the management, the plans, and all other details. It's a big document, and then you have the financials, of course. So you research the company, you figure out what price could be a good, it's close to the actual value of the company, and then that's the price you would give for this company. And then you look at the stock market, depending on if it's up or down, you decide to make a purchase or not, and then you wait for several years for the returns to come. So that's a good strategy. My problem with this strategy is that it's very hard to find opportunities. It's also very subjective. A lot of parts of
that kind of calculation involves a lot of subjective inputs. Say, for example, the risk that you assign to that company, I could assign, that there is like 80% chance that this company is going to do good, and then you give it 75. So it's very subjective. And then something called like the interest rate that you decide to divide all the future earnings by to come to the present value is also very subjective. And the other factors that you can consider hold true today but they won't tomorrow. So it's a little tricky, it's not easy to do, quite frankly, and yeah, it's still a risk, right? But it's a good risk management in a sense. Like, I don't really care about the ups and downs, the volatility that happens day to day, which is very typical. And then you buy it, and then hopefully in several years it'll bring you good returns. So it's not like 20 cents or like even 10% on your investments. It's like you could make a good 50%, 100%. So even though it's still a risk, it's a little more calculated risk. And then like you don't have to, bet 100% on all of, you can't be right, all the time. The rule kind of that, everybody goes with is that if like at least 50% of your bets turn out to be good bets and they're a bigger portion of your overall investment, you're gonna make money in investment. And then you have traders, like not specifically day traders, but like it's a more short-term trader, like they could hold it for weeks or months or even a year maybe, and then sell it. I think that's pretty much the main strategies that are out there.
Gotcha. So would you say, so we've kind of got like a spectrum of the short-term day trading investment versus the long-term value investing.
Mm-hmm.
Would you say that in day trading risk is high and in a more long-term investment risk is low? And is it kind of like the longer the investment, the lower the risk? Or are there like more factors?
Yes and no. There are way more factors to it. I guess the biggest risk in the day trading is like one, if you use margin account, when you use leverage to make the trades. So like that's one of the main risks. And then two, you're basically buying what you're not understanding. And then the way they do it is based on charts, and then based on different indicators. There are a bunch of them, and based on them you kind of predict where it's going to go next, like up or down. Like I remember when I did day trading, I don't know, for some reason there were times where like the next day, like when the market opens, the stock just shot up and then it comes back down. So like, to catch that uptake, there are certain trends that you start noticing. But then the problem is they don't always, like there's no rule to those trends. They just appear and they disappear, as they want to. So yeah, you can, make a good guess and you can be lucky to make good money. But then the same way you could get, pretty bad luck and then start losing all of the gains you made plus your own money. So, and also the danger in those trends is like when you start making little money, you're like, I know this, like I know, I'm noticing trends, and then you kind of feel like you're in control, and then the market comes back and is like, excuse you, I'm in control. So the market kind of shows you, that like who's the boss.
Yeah.
It's interesting, quite frankly, to like see all that play out. And it's very fine line between that and gambling.
Yeah.
So, because like, yeah, you have all those indicators, you have all those signs pointing at something to come up, but you don't know. Exactly, yeah. And then if you use, margin for that, it can magnify and it can like, come back like pretty hard at you and at your finances.
Yeah.
So it's a matter of, I guess, like if you, like I know some people or investors, traders have done a good job of risk management to have a successful trade. Because like you could put stop loss orders, right? Which means basically you instruct the broker that, and you literally like put in the order and say, you know, if the stock, the price drops to this dollar amount, I need to get out. So you put that stop loss order, and then when it drops to that amount, you know, it's closed. You cover your margin, you know, all the loan, and like you're good. So you're not like, you didn't lose more money than you could afford. So if you do a good risk management, it's probably, you know, doable. It's just you need to be very honest with yourself that if this kind of trading and this kind of volatility is comfortable for you. Because if it's not, you're going to make so many bad mistakes, one after the other, which are emotional actions rather than rational ones. And you're gonna have, like, you're gonna end up paying for that kind of lesson, like, a lot. So it's like, do you wanna, you know, test yourself? Which is okay, you can test yourself, like, you know, get $100 and start testing yourself. If you're not, because I mean, there are stock simulators, right? Which, you know, a lot of them are free, so you don't even have to sign up for the paid version. So you can do that. It's just when you do that, it feels like more of a game. So there's no money involved really. So you feel better. You feel more loose. You feel more relaxed, and you might do better than if actual money is involved. Because when actual money is involved, it's more like, you know, it's more like it's psychologically hard to see all your money drop, and you fall into this habit of like, yeah, you know what, it's gonna go up, like it's gonna go back, because you already saw that, you know, when it was higher, and you think, and you know, you convince yourself that it's gonna go up, and you let it like get more and more and more losses. So many traders would advise you to teach yourself how to accept losses. That's a better, you know, learning than the, you know, just buying it again. Because you need to be comfortable. That's part of the process. Again, the best traders would have 50% good investment, 40% all at losses, and then maybe 10% at a balance. So it's not every time like they make good money. It's, yeah, they go through losses, but they choose their battles. Like they choose when to wait it out and when to just get out of it and like, you know, just forget about that experience. Like it's getting through your losses and what matters in the you know, trading than making, you know, big gains. That's not the lesson.
You just want your overall gains to be more than your overall losses.
Exactly, yeah, exactly that.
Do you have any tips or advice to somebody who is just starting out investing in stocks?
Yeah, watch my video, 9 steps to start investing today. So I guess for someone to start off, I would start off by reading a lot of books, as much as you can. Find the time during your lunch breaks or before bed, however you feel. Like I can't read before bed, for example. For me, I feel like lunch breaks were usually the times that I would take the time to read. But whatever is convenient for you, just read a chapter a day, slowly increase it to 2 chapters a day, and you know, just understand different strategies. There are books that teach you how to trade, like, you know, specifically for traders, and then there are specifically for, you know, value investing strategy that we talked about. And then just, you know, understanding both, I think, is a good exercise. Even if you know, think that either one strategy is good for you, still read and understand different portions of each to see, you know, because you might think, you know, you like something, but once you read how it's done in practice and what are the ins and outs of it, advantages, disadvantages, I think you'll have a better idea of actually what suits you and your personality. So that's one thing. And then after you've read and understood, identify your risk tolerance. Risk tolerance is the most important part of starting investing, because And I mean, be honest with yourself. If you're risk averse, you're risk averse. Don't take risks. Invest in index funds, which I'm not sure we've covered, but they're basically following the market. The reason risk tolerance is very important is because you don't want to make emotional decisions. By emotional decisions, I mean, you know, when you're supposed to sell, like that's the rational thing to do, you wouldn't see that decision because your emotions are overpowering, because you're not comfortable with all the losses that you just had. When you're not comfortable with that kind of risk, you look at those numbers and you panic. And the only thing you can think of is, oh, like, I just want to sell it and I just want to be done with it, which is a very wrong attitude. You need to sell when you actually think that you made a mistake, the company didn't, turn out to be the way you thought it will. The financials show a very bad forecast. So you think, yeah, no, this was a mistake, let me just close it out and that's it. So that's a rational thinking, right? Especially in this recessionary environment, you just wait it out. That's the best case scenario for almost every industry right now. But when it's better environment, yet the company is not proving itself and it's been a while, then you're like, yeah, no, you know what? I don't think it's worth it. So that's you think rationally instead of rationalizing your emotions. So for that, you need to be comfortable with the risk. And you need to define it before you start putting in money. And if you're not sure, start with, $50, right? You can do a stock simulator, but as I mentioned before, it's not the same. Like, you need to put money to feel it. It gets personal, it gets, scary to lose, your hard-earned money. But, you put it in, you see, losing, $5, $10, I actually had an experiment when on my Cash App account where you could buy fractional. I put some and I decided to make it like super high risk version of trading to see how it will go, and it lost like 80%.
Wow.
80%. When all the slowdown and the dip in the market started, it lost 80%. I think it's still there, but it's it's tiny. I think it's like $100, and that was my testing.
Yeah.
And I'm not okay with that. Like, I'm not okay with that kind of risk. Those types of companies, if you invest in several of them and you kind of diversify, one or two might, give you a good return to cover the losses from the others. But I don't like it. I thought it was a bad idea, but it was a good experiment.
Yeah.
So you identify your risk. And open a brokerage account, and then do the test that I just mentioned. Also, one more thing, I guess, try thinking of the industries that you have an advantage in. Like, for example, if you are in real estate, you could look into real estate investment trusts. They're called REITs in short. You could look into those because you know the industry and the ins and outs. And I don't know, your favorite grocery store, for example, and you could, if you know enough about it, you could look into those. Like, getting into industries that you're comfortable with and you kind of know a little about. I would suggest, reading, for example, Peter Lynch. I think his books are a very interesting view on how retailers and someone who is not in finance industry, how you can, pick stocks. And I thought that was a very interesting overview, and he explains how you can utilize your knowledge towards, stocks.
Okay.
So Invested is another book, which is very beginner friendly, and it's about Danielle Town and her dad. Her dad is a very successful investor, and he teaches her how to invest. So she shares her journey, which was a very interesting read, how to start and how to kind of plan it out. And, she had a full-time job when she was doing it. So it's very doable.
Okay, cool.
This summarizes our today's chat with Alex, where we talked about stocks and some details and different strategies. If you have any questions, please comment down below and we will answer to them as best as we can.
Stay tuned for our next video where we're going to go into more depth when it comes to financial instruments like index funds and ETFs. So if you're interested in learning about that, we'll see you next time.
Yeah, and as always, thanks for watching and we'll see you. If you like this chat, please let us know. We would love to hear from you. And how did I say subscribe to the channel? Like, subscribe to the channel. I like the thing there.
Subscribe to the channel.
Yeah, subscribe to the channel already. Okay, please cut my loud laughs. If you like this series, let us know. We'd love to hear your feedback.
If you like this serious.
Oh, really? If you like this series, no. Yeah. If you like these chats, please let us know. We would love to hear from you. Now what? As always, thanks for watching. Bye.
Join me in my journey to financial freedom. Join me on my journey to financial freedom.
Okay.
He's making sure, so I'm just gonna cut the rest of it out.
Didn't you say it's on my journey?
Join me on my journey to
You just said in.
Sorry. Yeah. Grammar police. She didn't even know what word it was in the first place.
Hi, it's the second part of our series. Okay, it's the second part of our chat with Alex where we discuss about stocks and markets and investments, whatever you want.
Hi, it's the second part of our investment, our chats. Yes,
The Money
thank you.
Basics series.
Yes,
Okay.
yes,
Okay. With Alex.
yes.
Hi, welcome back to our Money Basics chats with Alex where we talk about
Money basics.
Yeah.
That was